What's going on, everyone? This is Lior and welcome back to my channel. In this video, I'm going to be talking about some of the differences between using hard money versus bank commercial financing for your next acquisition. Now, before I get into it, one quick thing. If you guys haven't already subscribed to my channel, smash that subscribe button for me. I put out tons of new videos every single week talking all about all the different facets of real estate investing, from acquisitions to financing to construction and so much more. So if you haven't already subscribed to my channel, smash that button for me. So let's get into today's content, where I'm going to be talking about the differences between using hard money lending for your next project versus going to your local commercial bank and getting a loan from them. So let's start with hard money lending, right? And let's quickly define what hard money lending is, because you may not necessarily have come across that term. Basically, a hard money lender is a lender that raises capital or money from private investors, and it's essentially a debt fund that is used to lend out to local real estate investors that are doing projects like fix and flips, condo conversions, and ground up construction. Now, let's go over some of the advantages of hard money. So with a hard money lender, let's say you call up a hard money lender, you've got a project that you want to tackle. The good thing about hard money lenders is, first of all, they'll typically give you pretty good leverage from on acquisitions as well as construction. And here's what I mean. On a typical deal, a hard money lender will likely lend you 75 up to maybe even 90%, I've seen, of loan to value on your acquisition price, right? So let's say you're buying $1 million building. They will, on the acquisition side, they will lend you anywhere from like 750 to maybe as even high as 900,000. The other thing they'll do is they will typically also lend 100% of your construction funds needed to do the project, right? So let's say you're buying $1 million building and you're going to renovate the property for, let's say, $500,000. So the lender's going to give you that 75 to 90% of the purchase price plus $500,000 for you to use to renovate the property. The other major advantage of hard money lenders too is they can act super quick, right? I've seen hard money lenders close deals in as fast as 5 to 10 days. Typical is, I'd say, is probably 2 to 3 weeks, but that can provide a really big competitive advantage for yourself as a buyer when you're maybe dealing in a really competitive situation, right? Let's say for whatever reason, the seller needs to really sell quickly and you can move the fastest. That could win you the deal. Sometimes you might be maybe buying a very distressed property that for whatever reason needs to be sold immediately. So in those kinds of situations, hard money lending is absolutely fantastic because they can typically close very fast. The other thing they will typically do is you will typically have 12, in terms of terms, you will typically have 12, maybe 18-month terms on the loan, right? So you're going to get 12 to 18 months to perform the project and then either refinance out the hard money lender or sell the building. During that 12 to 18 months, you're going to be interest only. So it's not like you're making full amortizing payments, which is really good, right? Because it keeps your cash losses during that construction period lower. And you're typically only paying on the total amount of money drawn, right? So let's say on the construction side, let's say it's only month number 1 of the renovation, and you've only spent $50,000, typically you will only pay interest on that $50,000 that you already used. It's not like you're going to pay the full interest on the whole $500,000 that you have asked for the lender. That's typically held in a separate escrow account. Now, the downside to hard money lending is the cost. It can be very expensive. In terms of interest rates, you're typically looking anywhere from 10 to 13%. I've seen people shop at even 14%. My suggestion is if you're getting 14-15% quotes, go shop somewhere else. That is really expensive. But you are getting pretty high interest rates, and then you're also going to be typically charged 1 to 2 points on the loan in order to close the deal. So plenty of advantages. You can move really fast. They will typically give you pretty good leverage, but you will be paying higher interest rates and closing costs and closing points on the deal. Now, hard money is really good for flippers and developers, but they typically they're really good for newer people that don't necessarily have a resume, right? Let's say you're only doing your first or second or third project. Hard money is going to be probably your path to go. Now, once you really start building up a resume, right, where you can show where you can show completed projects. You've also started to maybe build up a balance sheet. Maybe you own a couple of properties. That could be the time to start going and talking to your local community banks, right? Local community banks also finance a lot of local construction projects, whether they're condo projects, or they could even be rental projects, but they're also actively involved. Now, why would you want to work with a local community bank instead of a hard money lender? Well, right up front, they are a lot cheaper, right? So instead of paying 10 to 12% and 1 or 2 points on the loan, you're typically going to be around 4 to 5% in terms of interest rate, and then you're typically going to be half a point to a point in terms of closing costs. So obviously, much cheaper than a hard money lender. Now, some of the downsides of commercial financing. Again, not only do you have to be pretty experienced in order to even try and qualify, but in terms of the terms, right, some of the downsides are, A, they typically won't move as fast as hard money lenders. So whereas a hard money lender could potentially close a deal as fast as 5-10 days, although again, on average, it's probably 3 weeks, most local community banks will at least in my area and around Boston, will typically take about 40 to 45 days to successfully close out a deal. So it will take a little bit longer. The other kind of negative is you're typically going to be lower leverage. So I mentioned that there's some hard money lenders out there that can go as high as 90% on the acquisition and then 100% on the construction. With local community banks, you're typically going to be held to 75%, maybe 80% on the acquisition. And then on the construction side, you will sometimes get 100%, although depending on the bank, they might actually only finance 75 or 80% of the construction as well. So you're not going to quite get as much leverage as you would with a hard money lender, and it could be a slower deal, but your cost of capital is way lower, right? Again, instead of 10 to 12%, you're probably paying 4 to 5%. The other thing that's kind of cool with commercial financing is you can get a little bit more creative, especially if you're doing any maybe BRRRR projects, the BRR strategy, where you're essentially renovating and keeping the project as rentals. What a lot of banks may be able to offer you is some sort of construction to perm financing. And basically what that means is, like a hard money lender, you'll get 12 or 18 months of interest-only payments, but instead of the mortgage being due after that term, a local community bank can convert that mortgage to you to a fully amortizing loan. And then once the property's leased out, and that way you already have your 25 or 30-year amortized mortgage already on the property. So you don't have to go find a new lender. It just automatically converts on itself. So that could be an advantage depending on your model. But again, like I said, typically you're more experienced. Once you have more experience and you have a better balance sheet, most of the bigger investors will try to use local community banks. Although I will say there's certainly a time and place to use hard money. Sometimes you just need someone that can move really fast, and that can be a huge competitive advantage as well. So hopefully that makes sense, guys. I know I kind of went down through a lot of details in this video. If you have any questions, put them below, and I will help you out.